If you have extra cash, should you pay off your mortgage or invest it instead? Today we're going to look at historical returns based on a variety of asset allocations to help you make that decision. So recently I recorded another video that was titled, "Should I Pay Off My Mortgage or Invest?" And basically the gist of that video was, if you have extra money lying around, is it more efficient to pay down a mortgage or to invest that money, save it in either stocks, bonds, whatever investment you want, and put that money to work growing for you. Now, in that video, I addressed several factors to consider when you're evaluating whether or not to pay off your mortgage or invest. Some of those included: how much do you hate having debt? How far into the future is retirement for you? What's the condition of your emergency fund? Things like that. Now, these topics do get a little subjective, and I highly suggest that you go back and watch that video. I'll put a link to it above if you haven't already seen it. That should help build some context for today's video. After covering some of the more subjective topics, I did eventually get around to talking about the math behind the decision. When you're making this choice from a purely mathematical standpoint, you'll obviously want to direct your money to whichever option has the higher interest rate. If the interest rate on your mortgage is higher than what you can earn on the money that you invest, then you should pay off the mortgage. If you can obtain a higher rate of return by investing, then you should do that instead. Now, the math really is that simple, but forecasting returns on investments presents a significant challenge. After all, who knows from one day, week, month, or year to the next how investments will perform? Now, in the past, I've tried to avoid this lack of predictability by suggesting that one compared the interest rate on their mortgage to the risk-free rate of return, which isn't normally very volatile. There isn't really a completely risk-free rate of return, but U.S. Treasuries are the closest thing available to that, so that's what I proposed. Anyway, so the idea is if you can make, say, 5% on a short-term T-bill, but you only save 3.5% on prepaying part of your mortgage, then you want to buy T-bills, right? So, for example, if you have $1,000 extra you want to invest or put toward the mortgage, and the T-bill is paying 5% on $1,000, an annual rate of return on that would be $50 at 5% for your mortgage. At 3.5%, it would only be $35. So in this case, you'd come out $15 better for each and every year that you can manage to earn 5% from those T-bills instead of paying off that mortgage. For me, there's one small problem to using Treasuries to make this decision. I don't normally invest in Treasuries. Now, I do have some short-term notes inside of a money market fund, but that's for my emergency money, not long-term assets that I'm trying to grow. Now, recommending one thing while I'm doing something else seems hypocritical, so I thought I'd shoot a video explaining the decision I've made and why. Now, in my case, I have a mortgage with a balance of about $220,000 as a 3.5% interest rate, and I have about 22 years left on the term of the loan. Now, 3.5% is not a very high interest rate, so you can probably predict where I'm headed with this. I'm earning over 4% in my money market account right now, so this really is a no-brainer for me. However, like I already said, the decision to invest or pay off my mortgage isn't being made with money that I'm going to put into Treasuries. It's with money that I plan to invest for a long time. So how can I be confident that the other investments won't produce lower returns than 3.5% annually? Well, the truth is I can't. But what I can do is evaluate the historical performance of an investment portfolio like mine and compare that to my mortgage. And this is where some super helpful data from Vanguard comes into play. What you see in this chart is a summary of the performance of a variety of portfolios with varied asset allocations going all the way back to 1926. We have portfolios ranging every 10% from 0 to 100% from stocks to bonds. The red and blue bars record the best and worst years respectively for each of the asset allocations in the graph. The white line in the center shows the average rate of return for each asset allocation over the period. So for example, a 60-40 portfolios had an 8.6 average rate of return, a minimum single year return of negative 26.6% or a 26.6% loss, and a maximum single year return of 36.7% since 1926. Now, for reasons I'm not going to bother explaining right now, my asset allocation is 100% in stocks, meaning the historical average rate of return is 10.2%. Now, this far outpaces the 3.5% interest rate on my mortgage, so I see no need to pay off my mortgage early. Now, I should clarify that historical returns are in no way a guarantee of future performance. The next 100 years could look much better or much worse. There's no way to know for sure. The whole purpose of this is just to stir thought. You'll ultimately have to decide for yourself which course to take in your own situation. Hey, quick time out to ask two things. First off, if you watch my videos frequently and you've never subscribed, I would ask that you consider doing that now. Also, if you have a topic that you would like to learn about, feel free to leave a comment at the end of this video. I really enjoy actually writing and recording video about content that people want to learn about. So if you can leave a comment about something you're interested in, I would greatly appreciate that as well. Next, I want to illustrate how the result might change based on higher interest rates. If you've paid even a small amount of attention to interest rates in the last couple of years, then you probably know they've climbed quite a bit in that span. Now, as I'm recording this in September of 2024, a 30-year mortgage will come with an interest rate of around 6.25% if you have excellent credit. Today is a completely different realm than what we were in leading up to 2022, and it makes this decision a bit more difficult, especially if you're relying on the math alone. Well, to help compare the return based on asset allocation to the interest rate on your own mortgage, I built a little table that I hope will be helpful. So in the table, for the combination of mortgage interest rates and expected returns based on asset allocation where investing is advantageous mathematically, the cells are blue. So blue, you're better off investing. When paying off the mortgage is more beneficial, the cells are red. So blue for investing, red for mortgage. So as you can see, using this method, there will rarely be a scenario where it makes sense to pay off the mortgage early instead of investing the money. Where there was a tie in the interest rate and rate of return, I awarded the advantage to investing because it preserves liquidity, while money directed into a mortgage will be much more difficult to retrieve without selling your home. In fact, the only cases where the advantage shifts toward paying the mortgage is when you either have a very conservative investing approach or when you have a very high interest rate on your mortgage. So in summary, if your investing strategy is relatively aggressive and you don't have plans for the money within the next 5 years or so, then you're probably better off investing the money. Even if the interest rate on your mortgage is high, you need to bear in mind that there's value to having liquidity. If you direct cash into paying off your mortgage early, you will lose access to that money unless you either sell your house or take out a loan against it. As a result, if returns are similar to your interest rate, I tend to lean toward investing instead of paying off your mortgage early. And finally, the closer you are to retirement, the less the difference in returns over your interest rate matters because there's less time for the difference to compound and grow. It's just not as valuable because there isn't as much time. In that case, just having the mortgage gone for good or having a higher degree of control over your income in retirement may be more important to you. Now, the truth is, many people spend way too much mental energy on this decision. Odds are selecting a correct asset allocation for your goals and being careful about how much you spend on a house in the first place are going to have a much bigger long-term impact than the decision to invest or pay off your mortgage early. If you want to learn more about investing, I suggest you check out our investing playlist, which I'll put a link to down in the description below. We also have our website, martinmoney.com, which has just tons of information you can read at your leisure. As always, I am grateful for your time and your interest watching my videos. God bless and take care.